Stay with us. Let's add another voice to the conversation now. Liz Young is head of investment strategy at SoFi. There's just no doubt that money is cheap, Liz, and we're below 1.6 again. So you don't even necessarily see any of the harbingers of doom coming right now, and even in the bond market. So it's just let it fly still.
Well, I mean, the backdrop is, as you just laid out, money has been cheap for a long time. Yields have come down. So some of the jitters in the market that we had because yields were rising so quickly in a surprising fashion have subsided. So that sets us up for a little bit more success. But what I think people need to really watch and be careful about is, and the charts that Mike just showed actually illustrated this very well, we've had so many new highs. But every time we get this extended on technicals, there might be a little bit of a pullback. A little bit of a pullback is not necessarily a canary in the coal mine for this huge bear market, and I wouldn't want it to cause an overreaction. I do think we're going to continue to go through a period of rolling corrections, but that's okay. And ultimately, at the end of the year, we're higher than we are today. It's not necessarily going to be smooth, though. Could you ever see a policy mistake throwing a wrench in the works? If we were to go to 28% on corporate taxes, or if we were to, we're spending a lot of money. I don't know when that comes home to roost. I don't know. But is there a breaking point for whether it's Fed policy or fiscal policy or tax policy? Is there a point where that sort of poisons the well, do you think? I mean, I would love to believe that policymakers are perfect and they don't make mistakes, but I think history shows us that it's happened before, it might happen again. I do think the market is a little bit more sensitive to Fed policy than fiscal policy as far as taxes go right now. And there is a chance that there's something that gets signaled that spooks markets. But everything that we've heard Jerome Powell say is that that's probably not the case, at least not in 2021. So I think that Fed policy stays pretty steady. The Fed can and will wait to raise rates. And I think that that's probably something that the market enjoys through the end of the year. The real question mark is if the market starts to challenge the Fed. So if that 10-year yield starts to creep back up, which I think it will, if it starts to creep back up to a point that makes the Fed nervous, how do they respond to that? Both verbally, do they do something as far as yield curve control? And then the market has to digest that. And I think that is something to watch.
It's pretty amazing. Mike, do you buy that one guy, Jay Powell, is more important than, I don't know, how many politicians we got? 550 or 500 plus, president, all the president's men and women, the cabinet. So one guy. That's no wonder they call him the most powerful man in the world.
One guy marshaling the consensus of all the entire committee. But also, I think that's mostly because the potential incremental tweak to policy on the Fed right now that we could foresee might be more impactful than what we already know. I mean, the fiscal situation is basically baked. Yeah, we might get infrastructure. People talk about the big numbers for infrastructure, but that's over, 8 years? It's not. Next year, we're going to be talking about fiscal drag because we're probably not going to have anything like the extra stimulus packages we got this year. So I do think it makes sense to focus in on Fed policy, and I don't think that his nerve is going to necessarily break Jay Powell's, but the market has this push-pull situation where when it sees the economy really heating up, it says, you know what, he can't stick to it. And we got people pricing in rate hikes for 2022 or 2023 that have now started to get priced out. So the market itself is probably going to talk itself into and out of anxiety about that picture multiple times before, in fact, he changes policy, I would imagine.
Liz, did you say COVID? I don't think either Mike or you said COVID in the last 4 minutes. Is that just in the rearview mirror? Can we safely say that?
No, I don't think we can safely say that. I'll say it for you right now. I don't think COVID is completely in the rearview mirror, but when we look forward, I still think that the future is brighter than the present. And there are definitely some high impact, low probability events that could come up and cause us some harm later in the year. Things like strains that we can't control, we go backwards in the shutdowns, but I think those become lower and lower probability as we go forward. And as an investor, you can't invest on all of those high impact, low probability events because then you miss out on the more high probability events, which right now are that the market can continue to make progress. And I wouldn't want people to miss that economic expansion that continues to show in the data.
Shepard Smith here. Thanks for watching CNBC on YouTube.